Aditi, same question to you. With inflation kind of stabilizing, at least the fall is receding, if you agree with Rupa, do you think the space, therefore, for cuts now starts receding?
Lata, I think, I broadly agree with Rupa, and one of the most reassuring things that has come out of both the CPI and the WPI numbers is really the fact that food inflation is surprised on the downside now for 3 months in a row. And this is despite all the concerns that had built up about the unseasonal rainfall, the Rabi crop harvest being downgraded in the third advanced estimates, etc. And other than pulses, which as you rightly pointed out earlier, we always knew were going to be a major area of concern. For the rest of the food pack, I mean, whether it's your domestic buffer stocks or globally lower prices of edible oils and sugar, etc., I mean, there are a lot of mitigants that are in place, even if the monsoon turns out to be as bad as what the IMD has indicated. So I think that would be the key thing that I would take away both from the CPI and the WPI data, that going forward, at least we're starting off with a lower level of food inflation than what we had feared. And therefore, the situation may not be quite as bad as what we thought the day that the IMD reduced their monsoon forecast. Having said that, I would be still fairly confident that overall the average CPI for this year is going to be sub 5.5%. So I do think that there is still space for one more rate cut, even though we have seen core CPI inching up a little bit in the last month. It's, I think, still gone up to only around 4.6%. So it's pretty comfortable at this point in time, well below the level for the overall CPI that the RBI expects in January 2016. Okay. And, even with the WPI, I think the fact that we've reached a bottom, we did expect that this month's data was going to show that. Yeah. So not very surprising, and I think reassuring overall.
All right, so that's good to know. Rupa, would you agree that there's space for one more rate cut in the least?
Well, I more or less agree with Aditi's overall analysis of industrial slowdown and, CPI remaining in the sub 5.5% level. But at this stage, we cannot say anything very conclusively, because RBI will like to remain more cautious because, you see, this is just the beginning of the rainy season, and what really matters is its distribution. And luckily we have good water reservoir levels, and so far the performance has been good. But going forward, it all depends upon how the rainfall pans out in more irrigated areas versus less irrigated areas. So I think RBI will remain cautious, and the real assessment of the future stance of monetary policy we can make, I think, in the third week of July rather than now. And recent IIP number and today's WPI as CPI as well as CPI numbers, they substantiate RBI's stance that they may like to remain on hold until the monsoon uncertainty.
Rupa, that is the point. If you read this slight stabilizing of prices or the falling pace of fall, and if you read it with the higher than expected IIP numbers, are you getting a sense that growth is now better than forecast? Whether you look at growth numbers or at pricing power, is it looking better to you?
Growth picture is very mixed, because IIP numbers are highly inconsistent with the story conveyed by most of the leading indicators. Even if you take quarterly GVA numbers or corporate earnings numbers or PMI numbers, and you see, if you look at the IIP manufacturing, that series is highly volatile. So I think RBI will stay in a wait and watch mode, because we have made too many changes to our data series. And that's why to come at a very conclusive kind of an inference would take time. But yes, if you go by the recent high frequency data points, there is some scope for RBI to wait for some more time before, easing monetary policy in an aggressive fashion.
No, on the contrary, I thought it was indicating growth, and to be fair, IIP is the only index which has not been revised. So we are comparing like to like, unless GVA numbers or GDP numbers, which have gotten revised completely out of sync with the previous numbers. So we really don't have a historical trend. I was reading the IIP numbers, and it indicated to me that for the first time in many years, we are seeming to show at least a 4 or 5 month trend of slowly but steadily increasing industrial output. Vivek Rajpal, the rates strategist at Nomura, is also joining us on the phone line from Singapore. Vivek, the numbers, WPI number is at minus 2.36, not the most watched number, but it is better than what the street expected. The street was expecting a minus 4.6% or almost a minus 2.5%. As well, this minus 2.36 is not as big a fall as the previous month, April, when it was minus 2.65. Your thoughts on what will prey on bond dealers and on RBI?
So, as far as bond markets are concerned, market got relieved after CPI inflation number. I think we are at a stage where market got really nervous after RBI highlighted upside risk to the inflation in its previous meeting. And from that perspective, what we got as far as CPI inflation was concerned was more important. The market got a feeling that the inflation is stable, and from that perspective, it was relief to the markets. That's why we saw a positive reaction in the bond markets today. I think overall market is having a sense that, and I think this market needs to get this sense reinforced with every incoming data that inflation is stabilizing.
Okay.
And where it stabilizes is the most important part.
Vivek, what about